Time to rock. Ready? Yep. Okay. Everybody, welcome to the class on Baker's Dozen, the 13 monthly financial statements that you should be getting from your accountant, but probably aren't. And what we want to do today is try to help non-financial, especially people, understand financial statements, the value of them, what to do with them, how to ask for them, and things like that. Because if you're not trained in this, it's not always obvious. So here's the goals for today. We should be able to understand the roles that diverse financial statements play in your business, how to request these statements from your accountant, how to facilitate their development with organized financial record keeping, and why receiving a diverse array of financial statements is necessary for your business. This is also often a very overlooked and underfunded part of the business, and it leaves business owners dry. So today, the book that attends to this title is The Effective Executive by Peter Drucker. I've heard to him a lot, so some of you will know. He's sort of like the godfather of management consulting, kind of invented it. This is Robin Bundy, our book sponsor today. And the quote, I'll quote Drucker a lot, but if you can't measure it, you can't manage it. That's just straight up managerial fact. Otherwise, it's just guessing. So management requires the quantitative element behind it. And more than anything, this is going to be your financial statements. And the first thing I want to do here is say the net income is not cash, and not everybody understands this. I mean, everybody knows that business failure statistics are grim. I mean, after 15 years, only like 15% survive, or sometimes less, of businesses listed for sale. Fewer than 10% of those listed actually transact. And this has a lot to do with information asymmetry, which I talked a lot about in the enterprise value class. But the thing here is, why do businesses fail? All businesses fail because they run out of cash. That's the reason they fail, which means that you can be unprofitable and survive if you have cash. And you can be profitable and fail if you do not have cash. But net income is not the same thing as cash flow, and not even nearly. And so we're going to talk about why that is, where your money goes when it's on your P&L but it's not in your bank account, and what tools to use to help predict what's going to happen and to see what actually did happen. Because at the end of the month, a lot of people look at the bank statement and say, wait a minute, I did better than this. Well, no, you didn't. I mean, there's no tricks here. There's no leakage in the equation. It's just not understanding all the elements of the equation. So the role of accounting, I mean, it's obvious why people go to accounting school. It's not always obvious what they do. And it's kind of a little known fact that most of your Hollywood stars are there only because they washed out of accounting school, but it's kind of a Hollywood secret. So what is the role of accounting? I mean, there's sort of two kinds the way that I look at it. There's compliance accounting, which we see most people use exclusively, and that's to prepare a tax return. And then there's managerial accounting, because to operate profitably, exit successfully, to achieve your goals, you need managerial accounting, not just producing a tax return. The tax return does not help you make a decision. And if you ask your accounting department, or if you instruct your accounting department on what they should be doing, what is the job of the accounting department? It is not to record financial transactions. Yes, that's part of it. But the goal, the objective of this department is to provide information that helps business owners make decisions. That's what they're supposed to do. And they very rarely do that. So here, accounting is important, we say here, an important tool of qualitative management. Now, of course, it's a quantitative tool, but we say science first, art second. That means you do the math, and then you make your decision after you've done the math. We don't make gut decisions here. I mean, we do our analysis. We do break-even analysis, sensitivity analysis. When you understand these things, then you can make informed decisions, and not just like, oh, well, I feel like that's a good idea. I feel like that's not a good idea. No, you do the math first. You don't make it on hunches. You don't make decisions on hunches. Okay, so I mean, this is, if business owners, thank you. If business owners don't know how to ask, they're not going to get good financial statements. And like a lot of professions, I mean, CPA is a good credential, and there's a lot of good ones. But in all professions, there's bad ones too. And there's too many CPAs serving the market. And unfortunately, what a lot of times what happens is they'll take money for anything. I mean, lawyers do this too. All professionals do this where there's oversupply. So they take money and say, hey, can you do a pro forma? Oh, yeah. Can you run this projection for? Oh, yeah, I can do that. No, they can't do that. I see them do business plans. They don't know how to do that. I mean, from fitness, there's a saying, you're only in shape for what you train for. And they're not trained to do this, generally speaking. And so it doesn't really work out that way. So sometimes, generally everybody gets a P&L usually at the end of the month. Sometimes you get a balance sheet. But a lot of times you don't even get a balance sheet. And what do we just look at? What's the most important thing in the business? Is cash. What does not show up on a P&L? Cash. It doesn't help you at all to manage the most important thing. Often employees that are attached with accounting aren't primarily accountants. It's not even their only job. And then the accounting person, because it's not understood, it's not valued, becomes also the office manager and cleans out the refrigerator on Friday and is also shipping and receiving and sometimes picking up dry cleaning. But this is a real job that produces real value to help produce real positive results. We often ask our clients, well, what do you get at the end of the month? Your close package. This is our close package. The 13 statements, that's what you get every month, and that's what we mean by close package. And a lot of them say, well, I get a P&L. Well, it depends what I ask for. No, it doesn't. I mean, you ask once when you set up the business, and after that, it should just come. We had a kind of a sad but funny story when Glenn and I were out with a prospect a month ago, and we said, so what do you get for your close package monthly? And his answer was the funniest one, monthly? And he says, well, he says, at the end of the year, I get my tax return. And it's like, but that obviously doesn't help manage a business. It doesn't even attempt to manage a business. So you end up with haphazard QuickBooks reports. I mean, there is specialization to all industries, including healthcare. I mean, physicians should have a certain chart of account made for physicians. But if your bookkeeper's last job was at a hardware store, your chart of accounts is probably for a hardware store. It's probably wholly inappropriate and therefore cannot help you make good business decisions. So it's the setup is the main thing. And we see that businesses being managed by the bank statement, which is helpful, at least that has cash on it, but it doesn't tell you very much at all. I had a cousin way back in the day who said, "How can I be out of money? I still have checks left." And I mean that's hilarious, but it's like, how can my business not be doing well? I mean, I'm busy, but busy is a proxy for successful. It is not the same thing. So I just want to run through like the core financial statements here, and in just very cursory form, very stylized and simplified. And here, so the first one that we're going to show is the income statement. And I know not everybody in the world knows this, but the profit and loss statement is the same thing as the income statement. That's just the same word for the same thing. Also called the P&L. And in reading financial statements, I refer to this often as like when I started reading the Wall Street Journal, and everything in it is new, and it was hard to read. You would get tired out just after a few minutes, and after you go every day, the incremental knowledge in it was very small, and then pretty soon you're reading it, and it takes you 20 minutes to read the whole paper, really. And it's the same thing with financial statements. At the beginning, it's difficult. It's kind of like reading, even a foreign language, and then you come across, casa, okay, I know what that is. Abuela, great, I know what that is, and then you see mañana, and it's like, now you got homonyms, and homonyms are a problem. But in accounting, we don't have homonyms. 225 always means 225, and that's it. So in accounting school, we're taught to distinguish the statements, and the income statement, the P&L, thought to think of as a movie that records what's happened over a period of time. And that's why you see at the top of of your P&L, it'll say for the period, January through whatever, February 2016. It describes a period, unlike the other ones we'll talk about in a moment. Now, this presentation here is not strictly an accounting presentation, but a managerial presentation that I like to use. And I just want to go through this a little bit. Revenue, We'll talk more about that, cash versus accrual, the basis of accounting, but pretty much everybody knows what revenue is. Cost of sales in this context, these are the goods that are consumed in the delivery of this service. So, for a restaurant, it's the cost of, putting the hamburger in the bun. That's what that is. And that gives you your gross margin. The gross margin is how much you make less materials on each time you sell something. But the important thing here, and we almost always see this incorrect on the chart of accounts, is direct labor is always down in operating expenses, and that's not where it belongs. It belongs up here. This is the amount of the labor. This is the chef or the nurse or the doctor. These are the people who provide the service. So we have the goods and cost of sales, then we have the direct labor, and then we have what we're calling here contribution margin. So what is contribution margin? Well, that's what is contributed. Now, contributed to what? This is contributed to the machine that makes the thing run. So operating expenses, that's your overhead. That's your nut. That's what you have to make to keep the doors open. So now we see how many of these things do we have to sell in order to make our operating expenses work. And I'll probably do a different class on more, intricate analysis, but for now, this is what we want to do here. And then we see here, this is a statement, when you see as percentage of sales, we call this common sizing. This is a super useful tool in analyzing your performance. As percentage of sales, usually when you set this up, you can have benchmarks for this. I expect my occupancy cost to be 7%. My occupancy cost is 12%. Why is that? Did I make an out-of-market lease, or am I in the wrong location? And we'll talk about that real estate strategy in the branding episode, which doesn't sound intuitive, but it does fit in there. But super helpful in order to analyze the performance. Okay, so now we have the P&L up there, and the second one we're going to show here is the balance sheet. We see we have assets on the left, and on the right, we have liabilities and equity. All right, so we have three things, so why do we have two columns? Why don't we have a column for assets, and a column for liabilities, and another one for equity? Why is that? Because then it doesn't balance. We don't know if we have it right. This is how it balances. This is how we know that this is right. And unlike a P&L, a balance sheet shows the position of a company at a certain moment in time. So at the top of your balance sheet, it should say, if it's done correctly, it should say as of, not for the period. The for the period belongs to the income statement. This is as of December 31st, 2016. This is where the P&L is a movie. This is a snapshot. It shows the position. P&L, performance, income statement, position. Okay, now we have the third one, the statement of cash flows. This is kind of the marriage. This is the most important one. If you only got to get one, you're going to want to look at this one. This reveals the most about your cash conversion cycle. And what this is, we'll see here. So it takes your net income and your change in all of your balance sheet items. So this is the marriage of the two. And what I mean by that is look, the bottom of the P&L is the top of the cash flow statement, which means everything in the P&L is at the beginning of the cash flow statement. And we have our balance statement, our balance sheet balances. So we don't know it's right, but we know it's not wrong because of that. And we see that what's at the bottom of the cash flow statement is the top of the balance sheet. This is how all these things tie together. This is why this makes sense. This is the sum of all your income statement, and then here we have all the change in the balance sheet accounts. In order to do this, we need two balance sheets. For simplicity, I showed only one. So you take from this date to this date, the difference. Because if we want to be, I think that comes later, but I'm going to do it now. So if we want to kind of be anthropomorphic about it, we can think of the P&L, when you have revenue, your financial statements think that you have cash. So you have to tell it that you don't. And where's your cash? If your accounts receivable used to be, the prior period was $275, and now it's $475, $200,000 of your revenue did not go to cash. What did it go to? It went to banking your customers. You just lent $200,000 to your customers. That's why net income is not cash flow. I'll tell an example. I used to be with a company that we did importing. We imported from China. And the way you import from China is that you figure out what you want and you order it, and then you pay them half the money to get started on the order. And then it takes them, I don't know, sometimes 60, 90 days to fulfill the order. Then you pay them the second half before they release the container. Then they put the container on the ocean. The container comes in and that takes 90 days. And then it gets to Long Beach and they put it on a train. And then it gets here. Then it goes to a warehouse. And then you send it to your customer. And then your customer takes 30 days to pay, or maybe takes 60 days and takes a 30-day discount anyway. You can be extended there for 180 days on your cash conversion cycle. That's why there's a paradox of the more sale, if you have a long cash conversion cycle, the more sales you have, the more likely you are to go bankrupt. Because a certain level of capital only permits a certain level of growth. And that's what we want to keep an eye on as we go through these financial statements. Okay, so our financial statements, so there's 13. They come in, broadly, these are kind of made up, but in 4 categories. There's 4 current period reports, 3 year-to-date reports, 3 variance reports, and 3 supporting schedules. And so let's get started with that. So current period reports. That's the income statement in dollars. We kind of looked at that. We'll look more at this. And then we have this percentage of, this is the common size, the P&L. Then we have the current period balance sheet. And then we have the current period cash flow statement. This is the kernel. This is the foundation which we're going to build our other financial statements upon. Okay, so year to date, these are going to be very similar. So year to date in dollars, year to date income statement common size, year to date cash flow. Now, why were there 4 current period reports and only 3 year to date reports? Anybody have an idea for this? Which one's not on there?
Balance sheet.
The balance sheet. And why is the balance sheet not on here?
It's snapshots that do the same thing.
That's exactly right. Good man. We didn't even prep that. All right. Good job. All right. So yeah, that's why. So the balance sheet is as of a certain moment. So if you get it and it is the date that you want it to be, it doesn't matter. The time frame doesn't matter. It's only the date. There's no range, despite what some other people will declare in a lawsuit. All right. So budgeting and forecasting. All right. So we can think of there's bookkeeping. That's recording economic activity in a formulated manner. Then there's accounting, and accounting is preparing financial statements, which is what we're talking about today. And then there's finance, and finance is allocating scarce resources and achieving ROI and protecting against risk and all those sorts of things. That's why we see in the rearview mirror, this is clear. That's why we see in the front windscreen, this is not clear. It can't be. But the point of the budgeting and the forecasting is to set expectations that you can mark along the way. You have your mile markers as you go down the road. There's an old Persian proverb that's, thousands of years old that says, go as far as you can see, and from there you will see further. And of course that's true. I can see that mountaintop. I go to that mountaintop. I can see the valley, see all that stuff. That's what budgeting does for you, because we can forestall a lot of problems by seeing them coming. And if you're operating only by a bank statement or only by a P&L, you will not see these coming, and you will be reacting rather than managing. Okay, back to the baker's dozen. Now there's the 3 variance reports. I want to see my performance this month versus last month. I find that useful. I want to see my income statement this month versus my budget. Well, of course, that's useful. I set my expectations at the beginning of the year. I have an expectation that I want to buy something or take a month off or whatever, pay for whatever. Everybody knows uses of money. And it's like, okay, am I making it? Am I not? Am I ahead? Am I behind? And then that tells you something to research. I'm behind. Why am I behind? Okay, let's go figure that out. And then I want to see also my year to date. So I want to see not only this current period, I want to see everything up till there. Also, TTM or trailing 12 months is also useful. You could replace your year to dates with trailing 12 months. Generally, we do those on an ad hoc basis. We want to see it. It's simple to do. You go into QuickBooks, you just choose a different period, and you look at the rolling 12. So we can look at February last year through January of this year, trailing 12 months. And when it comes time to exit, so we won't, again, this isn't the exit planning one or even the enterprise value one, but in due diligence, you will be asked for trailing 12 months. You'll be asked for all this stuff, and it'll be super impressive if you can produce it, by the way. But in the trailing 12 months, that creates your run rate, your trajectory. So that's going to happen. And again, it's super easy. And one of the themes here I want to emphasize is if you set it up right, if you set your accounting system up right, this stuff is easy. I mean, most of this comes free. I mean, if you have two balance sheets and a P&L, the cash flow statement's free. But you ask most CPAs, most preparers of financial statements, at least in this town, they don't even know how to do it. I mean, honestly, they don't know what it is, and they don't know how to create it in the financial statement. I went to a good accounting school. I got good grades. I had no idea what a cash flow statement was until I went to work. I mean, doctors, you know what that's like. You get out of school, you don't know anything. And then you go to work, and that's where you learn everything. I mean, it's the same thing. All right, so now to supporting schedules. There's going to be 3 of these. This is your accounts receivable aging. And again, the note that most people in this room know, but I wanted to do a note on medical receivables, because unlike in manufacturing, I'm from Detroit, so I used to be in banking, so I had a lot of manufacturing clients. The older a receivable gets, the less likely it is to collect it. You get over 90 days, maybe that customer's broke. Maybe what you sold to them is no good. There's going to be a dispute. It's not going to be any good. If you have a medical lien, the longer it goes, the more valuable it is, because it's closer to the time where it's going to settle. And I wish we had more bankers here, because we need to educate the banking community on that, because there's sort of like native knowledge about old receivables and young receivables. But the insurance claims do pay, and the older they are, the closer they are to it. It's like Edison used to say that he failed building the light bulb, I don't know, like dozens of times or hundreds of times, and people ask if you were discouraged. He goes, no, something's going to work. He goes, all those things I've already gone through, so I know I'm closer to finding the right element to make the light bulb. So accounts receivable aging, this is you banking your customers. Accounts payable aging, this is your suppliers banking you. So you want to be careful here. If your terms with your suppliers are pay me immediately, and your terms to your customers are I'll collect in 90 days, you have a cash conversion cycle problem. I mean, it's tough. And another thing here is we always want to see the reconciliation of the bank accounts, because getting the bank statement is not the reconciliation of the account. And we're going to look at some quick examples of all of these things. All right, so current period income statement provides an indication of profitability, which is great. So profitability is essentially cash that you will collect eventually, but not now. The dollars is the traditional method of doing it, and as we see, we like to use common size reports for analysis, because you're looking like, wait a minute, something looks out of whack. I mean, it's hard to go through a dollar figure and spot something, but it's super easy to go through percentages and spot something. I mean, I expect, I sell something, I'm selling these footballs, and I charge $1, and I'm expecting it to cost me 20 cents to make it. And if I'm looking at my report and my cost of sales is 40%, well, now I know something. It's hard to spot that in a dollar. It's simple to spot that in a percentage. Okay, so so here's just a more detailed income statement. I mean, on the one that we squeezed in the previous example, it was very short. I mean, our company, my P&L is about a page and a half. Depends how intricate or at what level you want to manage your expenses. But the operating expense section can, be a lot. So anyway, that's a chart of accounts issue that we kind of went through quickly. Balance sheet, this demonstrates the company's financial standing. This is the position, what it owes, what it's owed, and what it owns. Yeah. It's a demonstration of liquidity and solvency. Again, any investor, a bank, anybody who's any user of a financial statement needs to know these things. And we're not going to talk about this today, except here just to mention that these are used for ratio analysis. There's more sophisticated tools to do more sophisticated planning from this, and to a lot of returns analysis, a lot of ratio analysis. And again, really that stuff comes free too. If you have your two numbers, all you do is divide them, or you multiply them, or subtract them. So balance sheet, I mean everybody pretty much knows what this is. It's set up. I want to make a note here a little bit more about the basis of accounting. There's cash basis and there's accrual basis. Cash basis, I think people understand pretty well. When I collect cash, that's a sale. But in other business, I might, if you book an insurance receivable, you do a procedure, you're going to collect, say, in 45 days. In accrual accounting, that's revenue today. In cash accounting, that's not going to be revenue to 45 days. So we see this a lot where we get a statement and it says, cash basis of accounting, and you have accounts receivable on it. Already I know you know what you're doing. You can't have receivables on a cash statement. You can't have payables on a cash statement. And you should have receivables and payables on an accrual statement unless everything that you do is settled in the same month. So again, that's not me as sort of a pseudo accounting instructor. Any user, a sophisticated user of a financial statement, when they look at it, what is that? They know it's wrong. They don't know how wrong it is. They just know it's wrong. That increases the risk. Risk goes up, price goes down. No one's going to pay for that. That's the information asymmetry thing. That's why 90% of businesses listed for sale do not sell for things like this. All right. Cash flow statement. There's 3 categories: operating, investing, and financing. Operating is kind of, that's what you normally do in your business. Investing is, things that, the regular colloquial term for that. And financing, I borrowed or I paid back what I've owed. Yep, we talked about how we do this, the difference in 2 balance sheets plus the P&L for the period intervening. And this does the job of describing, closest to the best job of describing the cash conversion cycle. It doesn't do it by itself, but to look to see that you have X amount of inventory or payables, receivables, tells you something, but to see the change in it over time tells you something else. And that's what we're going for. And so here's the 3 categories. We have operating. Well, in this case, we don't have any investing and financing. But yeah, we showed this, and this needs to be on your balance sheet. Now we have a full thing. So this provides same function, the year to date, as this. Yeah, we can kind of, I think we've covered this okay. So variance income statements, platform to compare the results over 2 periods of time. We show month-to-month change. Again, we like to see, month over month or period over period, so April over April, and also April versus March. And then the current month versus the budget, again, critically important. My exit plan is dependent on me achieving this plan. Am I ticking this off? Because you don't want to get, we know people who are, it's kind of almost an axiom to be, year 5 into your 3-year retirement plan. And that's why, if you got to tick it off as you go. You don't want to do that thing from Dumb and Dumber where you turn around and then you drive back to Kansas or what, I forget which way they went, but you drive 100 miles out of the way and you don't realize it. No, you got to look at the road markers. You got to see where you're going, and that does the best job of doing this for us. Yeah, okay. These answer different questions, which is the reason we want to use the full suite of statements. Is month-to-month net income decreasing, increasing, or is it stable? Are we on track with our budget projections? What line items are the cause of these changes in our monthly and year-to-date income statements? So here's a sample of a variance report. We have our results from this period. This is what we expected. This is the dollar difference, and this is the percentage difference. Now, this is easy to look. What do you want to investigate when you look at this? Well, I want to look at this, right? That's a good one. Okay, that's a big percentage. Where do I have big dollars? Oh, okay, $2,500. I got a big difference here, but it's plus. So my ratio is good, but my number's gone. So I know already that my sales have increased because it can't be any other way with those two factors. So we want to see, here's where I am, here's where I expected to be. How do we make decisions to make all this better? Receivable aging, yeah, we talked about this too. Blah, 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 blah. If you have internal or external billers, you need to get statements that show, days outstanding, amount in the queue, of course, the aging in buckets of current 30 to 60, 60 to 90, and so forth. You probably have seen these things. This is just how much is owed this month and how much is owed going out. And again, probably this will not come from your QuickBooks. This will come from your practice management software. It can be done in QuickBooks, but since already it's in the practice management software, we generally just use that. So this will be the one report that is generated outside of the accounting system, but reconciled with the accounting system in aggregate. But we don't need to have, your practice management software needs to have, Mike's account, Caleb's account, Tom's account, Steve's, has to have all that. QuickBooks does not have to have that level of detail to help you manage. So bank reconciliation, this is not just accepting what your bank statement says, because your book balance and your book balance and your bank balance is almost always going to be different, and it's going to be deposits in transit. So I have a stack of checks. I run the checks. I put them into the QuickBooks system. Now my accounting system thinks I have that money, but my bank doesn't think I have that money until they clear it. It's things like this: outstanding checks. Same. I mean, it's the same thing. Deposit, same idea between deposits and checks. Okay, so how to use, I think we're getting close to wrapping this up now, which is pretty much right on time. Use it to know where your performance, your position, and your trajectory. This is the best reflection of the health of your business, and leads you to your option points, which we counsel clients on a lot, because the thing is with option points, I mean, we don't have to decide. You don't have to decide today, do I want to sell? Do I want to buy something? Do I want to expand? Do I want to reduce my hours without reducing my income? Do I want to keep my hours and increase my income? All those things, you're going to do the same things in your business no matter what those things are. So we don't have to decide today, because we know the roadmap to the path to all of these things is the same. We can decide that later, but we know what we need to do now. So all these things: acquisitions, planning exit, reducing work hours, and none of these things are feasible. These are just random. These are, roulette wheel outcomes. And again, the statistics reveal this. I mean, businesses fail en masse. And, statistics so it's like 85% of businesses are done in 15 years, but in franchise businesses, like 95% survive. And why is it? They have tools. They have systems. When you read The Effective Executive, I mean, he'll say, a good company is a boring company. You change emergencies into routine. And the more routine things are, the more value the company has, the more likely you're able to achieve the outcome. And the book I think we gave in the first section was Michael Gerber's E-Myth Physician. It's the same thing, what you call like the franchise revolution. Even if you're not franchising your business, let's learn from that. Let's take best practices from the franchising community and install them into our business, even though we just have one location, and make the systems so that we will not fail and that we will achieve what we're attempting to do. So how do you get this? How do you get your baker's dozen? First, you ask for it. I mean, that's the first thing. And you might feel reluctant because, it's like, we feel reluctant to go in and challenge our doctors, and you guys probably feel reluctant to challenge your financial providers or other suppliers or, so-called experts in their field, but you shouldn't. You shouldn't. I mean, the same thing we do. I mean, get a second opinion. I mean, if they can't produce all these, and here's what they're going to say. They're going to say it's not worth it. It's like, why would you want all that? Nobody has that sort of stuff. It's like, yeah, but everybody fails. They fail and they can't sell. And it's like, so, I mean, they're like contradicting it. It's like, and it's not that much work. It's only that much work if you have to go learn how to do it. If you know how to do it, it's not that much work. I tell you what is a lot of work is fixing it. What's that? Yeah, I mean, to get it right and go down this track, but same thing, to turn around a freighter is a lot. Fixing it is a problem, but setting it up is not really a problem at all. Okay, producing, systems, and then the budget is the key. If you don't have a budget, you can only produce 10 of these statements because 3 of them were variance reports, and variance reports we have month over month, so I guess you could probably produce 11 of them. It's the primary financial plan, and again, to help you navigate down the road. So conclusion, get your financial statements. Learn how to read your financial statements. Have a regular meeting to discuss your financial statements. And if you like things like with a banking relationship or investor relations or even your family, if everybody's dependent on this on this business, knowing the path and having a plan and knowing where you are according to that plan. It's the same way, a lot of people have, personal financial planners, as Robin knows, and they talk about it the same way. It's like, well, here's how much money you need to do this. But it's often taken, the business is often taken as a given. But this isn't 1950s working at IBM where you're going to have this job for 50 years and you're going to get, just step grade increases. I mean, the business needs, this requires care and feeding. It's like, it's like you getting a dog. I mean, your kids are going to walk the dog. You make your kids walk the dog. Make your accountant produce your statements. A lot of things we hear, it's reluctance to change accountants because, something like, well, he's been doing a good job for me for a long time. No, he hasn't. He hasn't, or else you'd be getting this. Or something like, well, he's a really nice guy. Well, that's fine. I don't know. I think Will Smith is probably a really nice guy too. I don't know, but I wouldn't have to ask him to produce my financial statements. I mean, it's a completely different thing. Go ahead, have him over for Thanksgiving dinner. That's great. You don't have to not be friends with him, but don't rely on that. This is also, we're concluded here now. We'll take questions in a sec. This is the calendar of the future classes. This is also in your folder. And that's it. If you want to get in touch with us, that's our contact details. And I'm available for questions here. And we're always available for questions if you want to ring us up or stop by or send us an email or your preferred method of, you can ask us to come visit you. All right, so that's the end of the formal part of the show. So let's go to the informal part of the show. Yes, sir.
I had a question on AR, because you make it seem like something so exact. In medicine, I have a question on the AR, and you make it seem like it's so exact. You plug it in that last sheet, you get your balance sheet numbers. But in medicine, our AR is all over the place. I mean, we may be paid from an insurance company X amount, or we may not be paid at all. How do you account for that and create a balance sheet at the same time?
By averages. That's just for the broadcast, yeah. So by averages. So you'll want to take an average. If you don't know exactly, because what your contractual rate is, if you know exactly what you're going to be paid, because you do this procedure for this, I know. If you do, then you take your discount at the time of your billing, and then the net left will be your accounts receivable. If you don't know, you need to make an estimate of what that is, and then you take that reduction. And then over time, on average, you'll produce a number. We had a case where we were only collecting about 12.5% of the accounts receivable, but for various reasons that we don't have to discuss today, the accounting team was using an estimate of 15%. Now that went on for like 10 years, so the accounts receivable was overvalued by millions of dollars, by at least $6 million, which was, more than a little bit material for there, but by averages is the way you have to do it. Anybody else? Caleb?
Yeah, my question is about cash. You say cash is the most important thing. What do you have a recommended ratio of cash for a business that's like their target to keep on hand for planning, or does that just depend on what business it is, what industry, or what their goals are?
Yeah, it does depend. You can kind of do it like a household and say, I want to have, 3 or 6 months cash built up. But ideally, what we want to do is when you do your forecasting and you forecast your P&L, also the outcome of that is a balance sheet and a cash flow statement. So you'll project. You can't project, well, what are my ARs going to be? Well, AR is a derivative of your revenue, of your production from your balance sheet. But when you set this up, it shows what your cash is. And I would say, depending on the cash hungry nature of this, I would look at it as a number of months. And also, like I said before, a certain level of capitalization only permits a certain level of growth. So if we're expecting to grow a lot and have a long cash conversion cycle, we're going to need a lot of cash. So first thing we have to do is track how much cash is going to come from operations, And what the deficit is, either we have to make up in financing, either debt or equity, or we have to change our cash conversion cycle, pay our suppliers later, collect from our customers earlier, or rein in the level of growth. I had a customer, he was in an industry that there was a lot of exit. A lot of his competitors, it was overbuilt and were going out of business. And he wanted all that business. He's like, I can take it all. It's like, well, you're going to drown. You can't do it. You don't have enough money to do it because, like my importing example, he had a long cash conversion cycle. So the more orders that came in, the more he had to pay, the quicker he's going to run out. And that's fine. These type of problems are financeable if you know it in advance. You build your relationship with your bank or your investors and say, here's what I'm expecting to happen. I'm going to take on all this business. I'm going to need some money for this growth. That makes sense. But if you do that, if you go to the bank when you're out of money, they will not give you money because what did you just prove to them? You don't know how to manage it. You know how to sell stuff, but you don't know how to run a business. So that's fine. You can be a salesman in your company, but you need to bring in professional management. You need a CEO, you need a president, you probably need a COO, you need some infrastructure because I just watched you do this and you failed. I'm not investing in that.
What does the budgeting process look like?
The first time budgeting process, of course, is more difficult than a refresher of a budgeting process. But we do it by an interview style. I ask dozens and dozens of questions about what your products are, how much you charge for them, how much you collect for them, what it costs you to provide them, who works there, who's hourly, whose salary, what the capacity is. Robin knows. We just went through this, and we want to make sure with all our expenses, with everything we do, that we get to the core driver. Because one of the things I said before is we might expect our occupancy costs to be 7% of sales, and that's fine. But you don't budget it at 7% of sales, although you will see that done most times. You're going to put in what your rent is. Your landlord, there's break rent. Sometimes I'll pay $2,000, and if I have sales greater than $8 million, I'll pay you 5% of that. That's fine. That happens in retail a lot, but you budget it like that. You budget it by the driver. Some things are scheduled, some things are contractual, some things are percentage of sales. Your cost of goods is generally, it's a percentage of sales. I think I told the story last time too, but I had a customer in a restaurant business who called up and said, hey, our beer cost of sales is 24% and it should be 18%. Can you figure out what's wrong? I'm like, yeah, I can figure out what's wrong. I went down there and I asked him, how much do you charge for a glass of beer? How much you pay for a keg? And how many ounces in the glass of beer? And then you just figure it out. And they priced it at 24%. I'm like, this is what you priced it at. And they're like, no, that's not right. And he says, he goes, our keg room is so far away and there's so much beer in those tubes. And it's true. This was about as far away as I've ever seen a keg room. And it was in the basement. It was way back there. There's probably a dozen taps, and there's a lot of beer in there. But it's like, but that doesn't make any difference. That only makes the difference on the day that you fill the tube and on the day you empty the tube. All the other days, those tubes are full. It doesn't make any difference. And he kind of got it and felt there was some expertise there, but didn't believe it. And later in the afternoon, I saw him down in the basement with a step stool and a 12-inch ruler measuring the length of the beer tubes. And if you can't calculate cost of sales, I don't know how you're going to calculate the volume of the cylinder. And even if you did do so, I don't know how you prove that your cost of sales is something other than it was. But yeah, you go to the drivers, you figure out how that business works, and you model it out. It's and when I say you go to like CPAs, like, can you do this pro forma? Yeah, there's a guy who was selling stuff on the internet, like pro forma software, and it was cheap, and it should have been. I got it, and all he did is he took like his revenue for the year divided by 60. That was his accounts payable. It doesn't have anything to do with ramps up, with seasonality, with any changes month to month. There's no ability to do sensitivity analysis. So the budgeting process for us, it's a lot of Q&A. We sit down, we talk about your business, then we take the qualitative story of here's what's going on, Here's what I want to go on. And then we do the quantitative element of that, and then we budget. I'm rambling on this one, but I had a guy come in, he's like, okay, so he's a restaurant. What do you sell? We sell steak. Great. What do you charge for a steak? $20. How many steaks are you going to sell? 100. Okay, and then you go through, I mean, that with dozens and dozens of other things, and you come back, it's like, here's your revenue, it's $2,000. And he goes, I don't like what you put here. It's going to be way more than that. I'm like, bro, I didn't put anything there. Math put something there. I'm just executing the arithmetic. It's like, you want more than $2,000, you better sell more steaks or charge more for those steaks, or sell something besides steaks, or get a worse chair so your table turn is faster so you can get more people through there. I mean, there's always things to do. But that's where you start. You have to start with the quantitative. Here's my story. Does it get me to my Tahiti moment? I want to retire to Tahiti. I need this much money to do it. Does this achieve my plan? And we do. This is like the wind tunnel. It's like you don't have to build the aircraft and see if you can get it over the mountain and it's going to crash. We do it in a simulator. All right, do you like this? Is this the plan that you want to execute? You want to come to work every day to do something. Is this what you want to do? No. All right, that's where strategy comes in. Let's fix that. That's budgeting. Okay, well then let's wrap it up here. Thank you again, everybody, for coming, and feel free to reach out and check out our Bring Your Kids to Work pictures on Instagram and Facebook. It was quite a riot. Yeah, that was a good day. That should come more often than once a year. All right, thanks everybody.